Welcome back. Many companies these days are cautious on the economic environment, driven by increasing tariff risk, and are holding back from announcing deals. But a Canadian name has been actively focused on acquisitions. Stingray, the Montreal-based music, media, and technology firm, has been looking at deals worth up to $100 million. Stingray's latest quarter, meanwhile, showed that demand for its product remained strong and revenue exceeded estimates. It was up revenue 15% year over year. Let's talk about all of this with Eric Boyko. He's president, co-founder, and CEO of Stingray. Eric, thanks a lot for joining us. Your shares, we should show viewers your shares on the Toronto Stock Exchange. They are surging on the investor reaction. There they are, up more than 8.5%. After a quarter in which revenue increased by 15%, adjusted EBITDA grew by 19%, and adjusted free cash flow rose by nearly 18%. What was it that drove that type of performance in the most recent quarter, Eric?
Yeah, you know, it's and we said today on the analyst call, it's going to be 2 years in a row. Last year we grew by 10.4%. Organic sales this year are up 12.3%, and I was happy to confirm that in Q1, in our months of April, May, June, starting the year, we are also confident to have again double-digit growth. It's really coming from the U.S. U.S. sales were up 40%. We're much more involved in the U.S. with our partners, LG, Samsung, Vizio, Roku, Pluto, and we have more channels, and the advertising market is very strong. So we hit this vector. What happened is that, you know, when you buy a TV now in Canada, US, or the world, you get 250 free channels with Samsung or LG, and we put ad on those channels, TV channels, and that business is growing immensely. So when we're right in the middle of it, and we're probably one of the largest broadcasters in the world for those types of TV sets.
Are those your channels, those channels that come with a smart TV set, or are you
Yes.
placing ads on those channels? Those are your channels, are they?
Yes, we have about 20 audio channels. They go to Galaxy. They go to music channels on your cable. They're on those channels. And we have another 10 video channels that are ambiance, cityscape, cozy cafe, naturescape, holiday, more about relaxing videos and images. So we do very well because we're very much a laid-back business. And we always had the contacts with all these people from around the world. So our product is easily distributed all over the world because there's no wording, we're very well positioned. And both us and our partners sell the ads. So the TV market was a $70 billion advertising. Selling ads on CBS, NBC, CBC is $70 billion a year. And since people watch less TV, it's moving over to the connected TV market. So for us, we're just switching sales from an existing market.
You also own conventional radio stations, over-the-air radio stations here in Canada, correct?
Yeah, we're the largest owner with 120 radio stations.
And do you consider that a legacy part of your business? That certainly has the reputation of being a challenged business right now, the conventional media business.
Yeah, surprisingly, you know, at Q4 we hit plus 4%. In our first quarter, that, you know, because we're almost at the end of the quarter, we're aiming at 5%. We're winning a lot of market share. We're doing a lot more digital ads. And as you know, we also have a business that we do audio ads in stores, in Metro, in Loblaws, in Walmart, in Sobeys, in Dollarama, which, by the way, also had great results today. So happy for Neil. So the salespeople from radio are also selling in the retail stores. So we have a nice vector of growth there that's unique for our radio. That makes us different. So interesting that a legacy business, we're still doing well.
The company Stingray has raised money recently. Tell us how much you've raised and what are you raising that money for? People believe that you are interested in acquisitions.
Yeah, so we just, with the banks, we just uptick our line of credit to, I think, $600 million. So we have about $300 million of cash for us to do deals. We were talking to many different players in the U.S. early this year, but I must say that when the tariffs happened in March and April, Even our stock price was going up. I was skiing, it was going up $1 up and down. The US dollar hit 148 down. So I think the board and us, we decided to take a step back and just wait for these clouds to go through and probably be more active in the summer or in the fall. But I think we're in a good position, and our goal is to stay. Our debt EBITDA is getting close to 2, and our goal is to stay below 3 times. So we've got the cash, and we got some right targets. Just the environment has to be better.
Is this a good environment to be a buyer? Is this a time when you might find valuations coming down because of economic uncertainty?
I think so. I think that some of the deals we're looking for, every deal for us has to be accretive. And the 2-3 deals that we were looking at, and one of them is a bigger one, was very accredited for us with a lot of synergies. So, but it's just that it's very, the board, I don't know, our board right now, and even other boards that I'm on, everybody's very, how can we say, conservative with the geopolitics right now, which I think it's going to come down over the next few months, so which will stabilize everything.
As a CEO, what would you like to see Canada and the U.S. establish? What would you like to see the U.S. and China agree upon?
Oh, I think, Canada, U.S., we have to, so 2 points, we have to come to an agreement, and I'm confident that we will. And also, we have to think about, the U.S. is very deregulated. We do a lot of business in the U.S. Our growth in sales there is up 40%. Canada has to bring down its regulations. If not, we're not going to compete long-term against the Americans. Doing business in the U.S. Is much, much easier than doing business in Canada. And that's why on the broadcasting side, now 60% of our sales are in the U.S., and Canada only represents 20% of our sales.
What kind of regulations are you thinking of here in Canada that you think discourage make it more difficult to do business?
Well, I think there's no doubt everybody in the media space and the cable space will talk about, the CRTC has to loosen its regulations. We must file 80 or 90 reports a year. We have French content regulation. We have Canadian content regulation, Spotify and our friends at Pandora. Nobody has those regulations. We have to give X amount of money per year. And then I won't even go into regulations in Quebec, Law 96, forcing exec people to speak French in 6 months. I don't think that's very good for Quebec long term. We can't approach talent. So I think Canada as a whole, and I'm not even talking about the bill C-59 on the environments, we have to loosen up our regulation to be competitive with the U.S. because we're seeing it with Stingray. All of our growth is coming from the U.S.
Okay, let's finish with your view of the rest of the fiscal year, or the fiscal year that you're now in. You've reported late yesterday fourth quarter results and full year results for your fiscal 2025. So you're now in fiscal 2026. When investors look at strong double-digit growth in revenue, adjusted EBITDA, and free cash flow, they wonder how long a company can keep numbers like that going. What is your answer?
Yeah, we said it on the call with the analysts today. We feel in Q1 we're going to be again double digit, and we feel we're in a good position right now. We had a great start of the year, I guess, unless something major happens, to again have a third year in a row of double digit organic sales.
Eric Boyko, thank you for making some time for us today. He's president and co-founder and CEO of Stingray.